Hey there, Chip Harris again here with you. Talk about macroeconomic issues, situations, and of course, the housing market and how that economy relates to the housing market. With no further ado, I'll get started. Anyway, today, big day. As expected, the Fed raises rates another 75 basis points. So, another 75 basis points higher. Their Fed funds target rate is projected to be higher than they anticipated initially earlier this year, which makes me think in December they're probably going to raise again another 75 basis points. So here we go. We're still on the roller coaster. We're still on the ride. We're still heading up the mountain before we peak from an interest rates perspective. And of course, the markets didn't like that. They kind of went down today. They'd been on a hot streak from a stock market perspective over the last month in October, and lost a little bit of those gains today. But we're not here to talk about stocks. How does that affect the real estate market? Well, obviously, rates increase, market goes down, treasury yields go up, and of course, mortgage rates go up. So, with that being said, we're already in the 8% range for mortgage rates in a lot of cases, depending on credit score and lender. And so right now we're looking at probably getting closer to 8 to 8.5%. I bet you by January of 2023, from a mortgage rates perspective, which is an absolute dagger to the heart for the housing market. And so all that being said is the housing market continues to slow. Values are still elevated compared to a couple of years ago. Values have not lost traction and gone below their increases over the last couple of years. But what has happened is, and I've talked about this in the previous video, is the rate of increase of value month over month is declining, which means basically at some point in time in the very near future, we're probably going to get to the point where your house is worth what it is. And in the next months coming, maybe it appreciates by 1, 2, 3%, but nothing like the gains we saw over the last year and a half, or even this year. So if you look at gains this year compared to last year, which was incredibly robust gains for the housing valuations in the United States, houses are still going up in value right now, just not as quickly and at a much less robust clip. So all that being said, mortgage rates going up, values still hanging on for now, and in 2023 mortgage rates could probably exceed 8.5%. So that's not a bad thing in terms of the history of mortgage rates, which average out around 6.5 to 7%. We're a little over that right now. However, it's a dagger in the heart for the real estate market right now, because most people have been accustomed to and trained over the last 10 years to expect interest rates around 2 to 3 or maybe peak out at 4% for home mortgages over 30 years. And so it's just sticker shock big time for the consumer, anybody looking to buy homes. And of course, people who want to sell homes are second guessing selling that home unless they really need to, because rates are high. So when they move and they buy, they're going to have to pay a higher interest rate than they most likely have on their current home. And then the other reason is, there's just fewer buyers out there to buy your home. And so, yes, it's a down market, fewer buyers, fewer sellers. Not cool for real estate professionals like me, but this too shall pass. And I really look for, again, and I say this over and over again, a weak 2023 in the housing market. If you're a real estate professional or even potentially a buyer or seller, I think that right now your buyers are actually turning into better shape than sellers in terms of their negotiating power and their ability to maybe add in some credits for closing costs or home warranties, or even credits to buy down your rate to make it more affordable to buy a house. Sellers are more willing to negotiate those things right now. So if you're a buyer, you're kind of in the catbird seat, even though your rates are higher. Heard a great quote the other day, and I've heard it before, but I can't remember who I heard it from first. It is, you want to marry your house, but date your mortgage. marry your house, but date the mortgage rate, essentially. And so what that means is buy the house you want, stick with it, but you can always refinance later at a lower rate. And that way, that means just talking about, just date the rate, but marry the house. And so I'll pass that. That is not my quote, but I'll pass that on. I can't remember who I heard it from, but it's a good one. And so if you have any questions, you're always willing and able to comment to my videos, and I will respond if you have questions in any way possible. If I know the answer, and if I don't, I'll try to do some research and find out what that answer is. So I want to interact with you a little more often than we have interacted. But also, if you get any content value out of this, please like my videos, and more importantly, subscribe to my channel. I would love to have you as a part of the @ChipHarris1 family. And so we'll see you next time.